Thanks a lot, Kate, for the introduction. And I am quite disappointed not being able to attend in person. But that's the world we live in. So let's crack on. As always, what I'm going to do is I'm going to break the presentation down into three distinct parts. I'm going to start off with performance, what's happened both over the long term as well as in the last 1 year, what stocks worked, what stocks didn't work, and what some of the external drivers were for performance, especially style factors. Then I will move on to positioning, how we are positioned today in terms of sectors, in terms of countries, but most importantly, in terms of stocks. And I will share with you a few examples of the kind of businesses that we are invested in currently. As Kate mentioned, I will take the opportunity this time to talk about certain market observations that I have, or my observations on what's happening in the world. Generally, I'm not a big fan of talking too much about macroeconomics because you have as many opinions as you have economists. But I think we are in a unique period in time at the moment where I think any honest conversation of markets or businesses that we invest in can't be done without understanding the macroeconomic environment that we operate in. So with that, let's start on. First thing, let me just remind you for a minute on the process that we follow. My investment process is actually very simple. It's no different from the way you guys invest your personal money. So if you have 10 million pounds and you're buying a business in London, what do? You go look for a good business, you hire the best people to run it for you, and you try and buy it at the best possible price. You don't complicate your life too much. I try and do the same thing in the stock market. Buy good businesses, and by good businesses, I mean businesses which earn a high return on capital and can do it for a long period of time. So they're not a flash in the pan, and they are not businesses that don't make high returns on capital. Second, I try and invest with people who are honest and competent, because dishonest people will steal your money and incompetent people will destroy your money. So it's very important for me to invest with the right people. And finally, I want to buy businesses with a margin of safety. I do not want to pay full price. Once you understand what I do, it also becomes very clear what I don't do. So I do not invest in blue sky scenarios. I do not invest in dreams. I do not invest in leveraged companies. I do not invest in things which are well discovered and fairly priced by the market. Basically, I try and stay as far away as I can from the gambling instincts that you see very prevalent in the stock market at the moment. So with that in mind, let's move on to performance. So if you can move to, yeah, that slide is fine. So this is the performance of the trust NAV since I took over. And over that period of time, the NAVs compounded at roughly 10% per annum, slightly above 10% per annum, versus the market, which is both small and large cap indices, which have gone up by roughly 8.5% per annum. Now, this 1.5% outperformance, it's not bad, but it's not what I would expect of myself. If you remember, when I took over the fund, I had said that with small cap in Asia, 4 to 6% outperformance is very possible. We haven't been able to do it. We were on track till 2018, but the last 18 months have bogged us down a bit. So if we move on to the next slide, let's just go through what's happened over the last 18 months. All right, so if you look at performance over the last 1 year, the fund is up 31% versus the small cap index, which is up 34%, and the large cap index, which is up 6%. Over a 3-year period, the fund is up 11%, which is same as the large cap index, but the small cap index is up 16%. And this underperformance in the last kind of 3 years, especially between mid-2019 to mid-2020, where we underperformed the index by almost 15%, has been driven basically, in my opinion, by one big driving factor, but there have also been stock-specific mistakes. But stock-specific mistakes, as you know, happen with every fund manager. in good years and in bad years. What happens in bad years when your style is out of favor is that your mistakes get highlighted, and when your style is in favor, your mistakes get papered over. In terms of style, there has been, so what happened between mid-19 to mid-20 was there was a very big jump in growth stocks. So if we can move to the next slide, it'll become more clear. The next one, please. Yeah. So if you look at the first chart on top left, that's the performance of small cap growth stocks versus small cap value stocks since mid 2019. So the yellow line is small cap growth. The orange line is small cap value. There's been a 25% outperformance of growth stocks versus value stocks in the last kind of 2 years. And that's been a very, very big headwind for us, given 90% of the fund is invested in value stocks. Over our tenure, which is chart 2 on bottom left, growth and value have done similar. And over the long term, over the last 20 years, value stocks have absolutely crushed growth stocks. Now, the chart 3 that I show you where value has crushed growth stock is slightly dishonest because the starting point is 2000, where growth stocks were trading on an almost 80% premium to small cap stocks, which is the chart 4 on bottom right. Now, actually, that's very interesting because if you look at the premium of growth stocks to small cap value stocks as of now, they're trading at 90% premium. So it's a little bit like party like it's 1999. Everyone's kind of infatuated with growth stocks. Everyone's been putting their money there, and value stocks have been completely left behind. And that actually, even though I don't enjoy it, I don't mind it because it means that the sea that I'm fishing in doesn't have too much competition. You can look at your stocks at leisure. You can build your positions at the pace that you want, and you get to own some very, very good businesses without competition. That, in the long term, can't be a bad thing. In the short term, it is a headache. So, having kind of shown you that, I also don't want to say that all our performance problem of the last kind of 18 months has been due to style bias. Style bias has been a big headache, but not the only thing. So if we move to the next slide, let me share with you certain stock-specific detractors. So here we share with you the top 5 contributors and detractors over the last 12 months. Let's start with what went wrong, right? Granules India, and I will go in quite a lot of detail on this stock. So let's skip that for a moment. The next one is Hyundai Merchant Marine, and then there's a company called Yanming Marine. So that's been a very, very big miss. You know, every investor makes 2 kinds of errors. There are errors of omission and there are errors of commission. Errors of commission are when you own certain businesses and they go down. Errors of omission are businesses that you don't own and they go up a lot. And shipping for me was an error of omission. Hyundai Merchant Marine went up 5 times in the last 12 months, and Yanming Marine went up 20 times in the last 12 months. Both these companies, around mid of 2020, were close to bankruptcy. They would have gone bankrupt. But what's happened with COVID and supply chains getting stretched is that we are going through a once in a 100-year shipping cycle. Shipping companies are making so much money they can't even believe. A voyage from Shanghai to San Francisco, one voyage today, makes you enough revenue which would have bought you the whole ship 2 years back. So yes, we missed it, but if I go back in time, I still wouldn't have bought these companies because if you remember my process, I do not like to gamble. And buying bankrupt businesses is nothing but gambling. So I would have missed them once again. The other detractors, Alibaba, I can talk about it if you want, but I think the story there is very well known. And Zynga has been a detractor as well. I'm happy to talk about if people are interested, but in the interest of time, I'll focus on Granules, which was the biggest detractor. Now, if you go back 12 months back, Granules actually was our largest contributor. If we can move to the next slide, please. if you go 12 months back, Granules was actually one of our largest contributors. Granules is a very, very simple pharmaceutical company. It's based in India, and it focuses on generic, commoditized bulk medicines. So they are the largest producer of paracetamol in the world. They are the largest producer of ibuprofen in the world. They're the largest producer of metmorphin in the world, and a number of other molecules. But these three molecules are the base of their business. And these guys are brilliant chemists. So over a long period of time, what they've done is focused on process chemistry and process engineering to become the lowest cost producer of these medicines, wherein they almost have 50% market share in some of these medicines globally. And that has allowed them to continuously increase their revenues over a long period of time and make more money as they do it. I bought this stock between 100 and 150 rupees a share at the end of 2019, when it was trading on 10 times earnings, and the market had completely ignored it. And then we had a great run where the stock went from 100 rupees to close to 400 rupees. And over the last 12 months, the stock's come off 15%. So it's not been that bad, but in a market that's up 35%, your top 10 position going down 15% hurts you a lot in terms of taking performance away. Why has it come off 15%? They've had a difficult time in the last 6 months. Most of the active pharmaceutical ingredients, or commonly known as APIs, most of their APIs come out of China. And with the energy shortage in China and with stretched supply chains, they haven't been able to get their raw materials, as well as the price of raw materials has spiked up a lot. And this company, being a good citizen, didn't raise price of drugs initially, as they wanted to see what happens to raw materials. And so their margins have come under pressure in the first 6 months. They've started to raise prices, so the price of your paracetamol is going to go up, and the price of your ibuprofen is now going to go up, because they have now started taking prices, given that the costs have increased structurally. So I have no doubt that the business will come back. When we look at their pipeline, when we look at what's coming in terms of products over the next 3 years, when we look at the geographies they are entering over the next 3 years, I am very confident that this business has many years of double-digit growth in front of it, and we're paying 12 times earnings for it. So I haven't really changed my position. I've been thinking of adding more, which I may at some point in time, given that we're buying a very, very solid business, which has a history of growing 20% over the last decade, at 12 times earnings with a clean balance sheet, and makes a return on equity close to 20%. So yes, it has been a detractor, but I'm not worried at all. And if anything, I am more inclined to buy rather than do anything else. If you go to the next slide, I also want to tell you it's not been all bad. When a fund is up 30%, we must have done something right as well. And I wanted to share a stock which is a very typical investment for me. It kind of personifies my investment process in a way. It's a company called Hinduja Global Solutions. Again, a very simple business. They are a business process outsourcer, right? So 60% of their business was healthcare. So they would work with insurance companies. So every time you have a healthcare issue, you file for your healthcare insurance claim, most likely it is going to somebody like Hinduja Global Solutions, who then processes your claim, sends the money either to the doctor or into your bank account. So it's a very simple business where they play the cost arbitrage between the Western world and the emerging world. So they have their processing centers in the Caribbean, in India, in Philippines, and they service clients like Cigna, Aviva, etc. Actually, they work with NHS as well in some of their businesses. Now, this is a business I bought a couple of years back. The stock was trading at 3 times EV/EBITDA, 6 times earnings, net cash balance sheet, with a history of growing double digits for a very long period of time. No one wanted to look at it. Small company, completely ignored, but a fantastic business. And this is the kind of businesses I want to look for, where no one else is looking at those businesses, but the underlying business is fantastic. We bought the stock. Nothing happened for the first kind of 12, 18 months. And then some people started looking at it. And then finally, Barings private equity came and bought the healthcare piece of their business, which is 60% of the business, for 4 times the value than the market cap that we paid to enter the whole of the business. So Barings paid 1.1 billion just for 60% of the business, and we'd paid 250 million to buy the whole business. So it's been a fantastic investment for us. As you can see, I have taken money off, but it's still a reasonable size position for us, given that the market cap of the company is still less than the cash on the books. And they have 40% of the business left, which is still annuity in nature, where they do business process work for clients other than healthcare. So it could be call centers for guys like Procter & Gamble or Unilever, or for airlines. That business is still growing at double-digit rate, and the EV is less than cash on the books. So I'm very happy to continue owning this business. It's a great management team who've delivered value for us. We've made a lot of money on this stock. I think we made 4 or 5 times what we paid in, and I'm happy to continue to own it. So that's just a little bit to give you a flavor of what drove performance from a style perspective, but also from a stock perspective. I think if we move on now to fund positioning, it'll give you a better idea of how we are positioned for how I think the world works from here. So if we go to the next slide, this is just a snapshot of the sectoral allocation of the fund, as well as the geographic allocation of the fund. And as you can see, China plus Hong Kong together is close to 30% of the assets now. India is close to 20%, ASEAN's 15%, and then Taiwan, Korea are 10% each. But I think you'll get a better understanding of what I've been doing if you go to the next slide, where you will see a time series of my allocation by country. And you will see that I've been actually deploying more capital into China and taking that capital out of India. And this has become a little bit more stark in the last kind of 2 or 3 weeks. Why do I like China when every headline you read about China is negative? So if we go to the next slide, this is basically just the valuations by country of the small cap market. On the left is the price earnings ratio, and on the right is the price to book ratio. And as you can see, China is the only country which is cheap on an aggregate basis, both on an earnings basis as well as a cross-cycle basis, like price to book. Korea, Taiwan are okay on price earnings, but Korea and Taiwan are full of very cyclical businesses, technology, hardware, shipping, chemicals, and the margins in these businesses are quite elevated. So if you look on the right on price to book, actually Korea and Taiwan are quite elevated as well. And for India, I am speechless. I don't know what to say. That country is on a completely different trip. The valuations don't make any sense. There are stocks trading there with 5 billion market cap, where the revenue is less than the wages of that business. It's in a completely different mindset. And the price to book is 4 times. Price earnings ratio on aggregate for the index is close to 28 times. I really am speechless. Now you will ask that, look, you have 20% of your fund in India, and the valuations are like that, so why do you own? The beauty with India is that, like most markets in the world, it's quite bipolar. You have a group of companies which are on absolutely ridiculous valuations, 75 times, 100 times, 150 times earnings, a lot of loss-making businesses with big market caps. But also in India, you have a bunch of businesses which are on ridiculously cheap valuations. I can buy businesses in India on 4, 5, 6, 7 times earnings still. And when we go through the top 10 positions, you'll see some of them. So if you look at the aggregate PE of what I own in India is only 12 times. It's nowhere close to what you see on an aggregate basis in the market. So that's the reason that I have been allocating more capital to China. As we go through some of the stocks that I own in China, you'll get a better flavor of what I'm talking about. If you move on to the next slide, you'll see that whatever I say is also very evident in the fund aggregate data. So this is the price earnings ratio of the fund versus the price earnings ratio of the market on the left, and return on equity of the fund versus return on equity of the market on the right. So you can see that the average price earnings ratio of what we own is 9 times. Generally, you pay 9 times when you are in recession or where the outlook is horrendous or the businesses are in big trouble. We own actually tremendous businesses. Most of what we own are market leaders in what they do. They make much higher returns on equity than the market on aggregate does, and have better financed balance sheets than the market on aggregate has. But they are on 9 times. And that's what I mentioned earlier, that the markets are slightly bipolar, not slightly, actually quite extreme in terms of how bipolar they are, which is good because we continue to own these good businesses, find a lot of these good businesses, and can continue to invest in them with a big margin of safety. Same thing if you look at the next slide, which is our top 10 positions. And you just eyeball the three columns that I've marked with red arrows. You will see the price earnings ratio, the dividend yield, and the return on equity of our top 10 positions. This is quite extreme for market leading businesses. I think 7 or 8 out of these businesses are market leading businesses. It's again an indication of what I've been saying, that we are finding very, very solid businesses, and I'm confident in what we own. To own these businesses at these valuations, you would think that these businesses are in deep trouble. And as we go through examples, you'll see they are not. So let's get to the examples, right? Let's start with China Yongda, which is on the next slide. So China Yongda is, again, a very simple business. It's an auto dealer. They sell cars. They're the largest dealer for Porsche and BMW in China. They also do a little bit of Toyota. They also do a little bit of Mercedes. But base of the business is BMW and Porsche. As you can see from the charts, they have a tremendous history of growth in the past. And the growth is being driven basically by 2 things. One, car ownership in China continues to go up as the country becomes more wealthy. And second, that given that these guys basically play in the premium end of the market, as Chinese get more wealthy and they want to show off their wealth and they aspire for a better lifestyle, the premiumization trend in China continues. So more and more people want to buy these luxury brands. And that plays into their hands. Also, the market continues to consolidate as the more efficient, larger dealers take market share either through acquiring small businesses or the smaller dealers leaving the market completely. The business quality continues to improve over time because when a car market is very young, most of the profit of a car dealership is made by selling new cars. And that part of the profit is actually not very valuable because it's very cyclical. But as the car market in a country starts to become more mature, the quality of the dealership business improves because most of your earnings actually start coming from after-sales services, whether it's servicing or accidents, etc., that happen with these cars, and they come back to the dealerships and they repair. And over the last 5 years, this business has moved where majority of the profits used to come from selling new cars to where a vast majority of the profit now comes from after-sales services, which is an annuity kind of business. So the quality of the earnings has improved. In addition, what the business has done over the last 12 months is they used to have a car financing business on the balance sheet, which made their balance sheet quite levered. They've gotten rid of that. So now actually they have best-in-class balance sheet as well. We got into this stock at around between 6 and 8 Hong Kong dollars. And it's done well for us. I mean, it's 12 Hong Kong dollars now. But even now, this business is trading at 7 times earnings. For the largest dealer of Porsche and BMW in a country which is still getting wealthy, yes, China will have issues, but I can guarantee you China is a much wealthier place 10 years from now than it is now. As people get wealthy, they will aspire to buy these luxury brands. And as people buy luxury brands, Yongda is a very good way to kind of sell them, those luxury brands. And we're paying only 7 times earnings for a business which is making close to 20% ROE and has a clean balance sheet. So that kind of probably gives you a flavor of what I own in China. The next stock I want to talk about is actually also a Chinese company. If you go to the next slide, it's called Sinotrans. Sinotrans is slightly more complicated than the businesses I've talked about so far because it's a logistics business. So what they do is they are freight forwarders. So if you want to export out of China, you have to do a lot of custom clearances, a lot of form filling, book the ship, etc. And these guys will do it for you. Same way, if you're importing, you have to do customs clearance, then transport the goods from the port to your factories. These guys will do it for you. They are the largest logistics, freight forwarding, and express delivery company in China. It's a government-owned company, though part of their business is jointly owned with DHL. So they're the largest express delivery company in China, which is a 50-50 JV with DHL. They have a consistent track record of growth and make a reasonable return on invested capital of 10%. The ROE is also 10%, given that they have no leverage. And we're paying. So I bought this business when we got COVID last year. And the stock got really, really cheap. It was trading at 5 times earnings. And I felt for a business which owns so many assets, has such a massive network effect, 5 times earnings was very cheap. And since then, the stock's done well. The earnings have gone up a lot. But over the last kind of 3-4 months, the stock's come back down. And now it is actually closer to 3 times earnings, which to me is absolutely ridiculous for a business of this quality. They have no debt. They are the largest logistics player in the second largest GDP of the world. And the market seems to suggest that this business will not extend beyond 3 years. I am very sure this business is here in 30 years' time. So I'm very, very happy to own this business. You're getting a very high dividend yield of 8%. And given its Hong Kong dividend yield, we don't even pay taxes on it. So it's fantastic for me, again, to own this business. Again, I think these examples should give you a sense of what kind of businesses I like to invest in. These are cash-generative businesses with very solid market positions, with good management teams and valuations which leave a lot of margin of safety for bad luck, for bad decisions, and for bad judgment. But I think there's so much margin of safety in these businesses. I'm really, really happy to own it. And I hope this gives you a little bit of confidence, or I can transpose part of my confidence in what I own to you guys by sharing some of these examples. So let's then move on from stocks to a little bit more kind of macro. And if you have any questions on any of the stocks, any positions I didn't talk about, I'll be very happy to answer them in the Q&A. So in market observations, let's start with the 2 fundamental blocks of economic policy of the world, which is fiscal policy and monetary policy. And the chart on the left is fiscal policy. And that's basically the fiscal deficit of the 5 largest economies in the world. So USA, China, Germany, Japan, and India. And when I look at this chart, I am speechless. This goes back to 1954. So this is not a short-term chart. This is very long-term. And the governments of the world are behaving like a teenager in a shopping mall with an unlimited credit card. I really have no words to explain why they are doing what they're doing. The fiscal deficit of the 5 largest economies in the world is now running at $7 trillion. 11% of GDP. This is, or 12% of GDP. This is absolutely astounding. This is very experimental, but this money has been flowing around the world. So we went through massive COVID, we went through big unemployment, but there was no recession because the government basically threw money at people. Everyone got free checks. And the way the world's been working, or the way everyone's been behaving, is that this is consequence-free. You can keep doing this, and there will be no consequences. And I hope everyone is right. But I do worry when I look at something like this. And I will go through the consequences of, or my interpretation of consequences of what the policy has been. On the right, what you see is the monetary policy. So fiscal policy is basically government revenues minus government expenditure. Monetary policy is how the government decides cost of money. So interest rates in the economy. The orange line is the inflation in the US, and the blue line is the Fed funds rate. If you came from Mars and you saw this chart, you would be scratching your head. Inflation is running at 6%. It's the highest inflation in US since early 80s. And interest rates are zero. Again, this chart goes back to 1950s, right? So you can see historically, the government has always had a cost of money. So interest rates have been higher than inflation generally because there should be a cost to money. But there isn't. Inflation is 6%, rates are zero. So basically what the governments are telling, well, two things happen. One is that this is obviously very unkind on savers and very kind on borrowers, right? So people who are borrowing are laughing to the bank. People who are saving and are kind of more careful with their financial situation and have money in the bank, they get nothing on it. So what the government is telling people is go and gamble. Your cost of money is zero, and go and do what you want. And you see that, if you move to the next slide, you see that very clearly in how people have been borrowing and what they've been doing with that. So this is margin debt to GDP. Let's start with US, right? So the orange line is the margin debt, and blue line is the stock market index for that country. So historically, in every bubble in the US, margin debt to GDP peaked at around 3% of GDP. So in the tech bubble in the US, margin debt to GDP peaked at around 3%. That's the spike you see. Then again, after the housing bubble in the US, margin debt to GDP peaked at around 3% before the great financial crisis. And then we were back at 3% by around 2018-19. COVID happened, margin debt to GDP came down, and then government gave a free chit to everyone to go and gamble. And now we are at 4.5% of GDP as margin debt. Margin debt is basically what people borrow to gamble in the stock market. This is, again, every chart I'm going to be saying I'm speechless because I really am. I really have no words to explain what is happening here. You go country by country, you see the same effect. Same thing in China, same thing in Korea, same thing in Taiwan. I haven't put the charts of Vietnam, India, Thailand. Everyone is the same. People are just borrowing to speculate. What does this do? This obviously leads to, if you move to the next slide, this obviously leads to a spike in the markets because there's more money chasing the same stocks. And the chart on the left is basically global market cap to global GDP. This is the Warren Buffett indicator in a way. So Buffett's red light starts to go when market cap to GDP gets to close to 100%. And as you can see, we got too close to 100% in 1999 at the peak of the tech bubble, and then again at the peak of the housing bubble in the US in 2007. Now we are at 125, 130% of market cap to GDP. People have been given money to go gamble, and they are gambling. And that's driving up stocks, and that's driving up valuations. That you can see on the chart on the right. Chart on the right is the global cumulative market cap of stocks on price to sales more than 15 times. Not price to earnings, not EV/EBITDA, price to sales of 15 times. We have $14 trillion of stocks with price to sales more than 15 times in the world. You know, I have analysts who come and pitch me stocks. Oh, this is so cheap, it's only 10 times price to sales. And I look at them and I wonder what they're thinking. To get a 10-year payback on a stock which is 10 times price to sales, I have to assume that this company has zero costs for the next 10 years. And they will give all their revenue to me in dividends. They will pay no tax on that dividend when they distribute, and I will pay no tax on that dividend when I receive. And then I get a 10-year payback. It's impossible. I'm not saying that all the companies that are on 15 times price to sales don't deserve it. There will be some rare cases who deserve it. But I think 90% of these companies do not deserve it. And last time we had something like this was in the tech bubble of 1999, where the market cap of stocks with more than 15 time price to sales reached 4 trillion. Now we are at 14 trillion. You can say, look, all this is fine. What you're telling us is that the government is fiscally irresponsible, monetary policy is too loose, people are borrowing to play in the stock markets are high, value, some stocks are extended, but what about valuations? So if we move to the next slide, these are the valuations of the markets. So let's start with the stock on the right, yeah, which is, again, I'll take US because it's the longest history. This is S&P 500, which is the orange line, and the CAPE ratio. CAPE is cyclically adjusted price earnings, which is basically you take the market cap and divide it by the average profit of the last 10 years to take out any cycles out of that. This is a very long-term chart. This goes back all the way to 1880. And you can see 3 peaks in this chart. The first peak was in 1929. The second peak was in 1999. And the third peak is now. I do not need to tell you what happened in 1929 and 1999. And we are on valuation metrics as well, very close to those 2 periods. So you have to be really, really careful with anything you do with your money at the moment. On the left, I'm showing you EV sales of US on the top, which is very extended, and Asia at the chart on the bottom left, where you can see Asia's not cheap either, but it's not as crazy as the US. So it's relatively better off, but by no stretch of imagination can you say that it is cheap. So, you know, all these charts that I've shown you, or all the data points that I'm sharing, each one of them is eye-catching on their own, but each one of them individually can be rationalized. But when you put them together and you look at symptom after symptom after symptom, it's very hard to ignore what's happening in the world. And this is before I even talk about what's happening in the crypto world and NFTs. I mean, that's a completely different game that people are on. So I don't know actually what to say. You know, they have this saying that if it looks like a duck, swims like a duck, walks like a duck, it probably is a duck. I don't want to say if it's a bubble, but it surely feels like one. You know, Warren Buffett has this very famous saying. It goes something like, a pin lies in wait for every market bubble. And when the two eventually meet, a new set of investors learn some very old lessons. And I think there is this new wave of investors who are playing in the stock market, but also with cryptocurrencies and NFTs, and now this metaverse. And I do worry about what will happen to the financial condition of these people, because this is not sustainable, in my opinion. So let's kind of conclude, and then we can move to Q&A. So we can just go to the conclusion slide. 3 or 4 messages that I want you to take away. Firstly, we are in a very experimental world. The economic policies are very experimental. There is no playbook for these economic policies. I do not know how they will end. I do hope that the governments and the central bankers know what they're doing, and I am wrong, because that is the best case outcome for all of us. But having said that, hope is not a strategy. I think we have to stay vigilant and we have to be nimble. And I'll be watching what happens very carefully. Second is that use of leverage in the markets is at extreme levels. Historically, use of leverage has always ended badly. The only way this leverage makes sense is if you believe this time it's different. And those are very dangerous words to believe in financial markets. Having said that, the stock market continues to be two-paced and very bipolar. On one hand, you have these extreme valuations where there is a lot of speculative gambling type behavior, but on the other hand, there are stocks which are completely ignored. I will not be surprised if we go through something like what happened after 1999, where even though the markets went down, there was a large group of stocks which went up materially. A lot of value fund managers had their time in sunshine between 1999 and 2003, because value stocks actually appreciated a lot at a time when the whole market was going down. because they were completely ignored and were not a part of all the margin-driven speculation. Asia is in a better shape than the West, but I do not think it's risk-free. There are a lot of opportunities in Asia, but there are risks as well. And the risks emanate from the same kind of behavior from governments that you see in the Western world. And finally, as I've tried to show you with my top 10 positions, with the stock examples, with the fund valuation chart, I think what we own is very solid. These are businesses run by incredible managers. They have very strong market positions. They generate cash, and we're buying them at margin of safety with big dividend yields. So I do feel very confident in what we own, but I will be vigilant on what's happening in the world. And I think with that, I will stop, and let's have some questions if you guys have any.
Thank you very much, Nitin. If you would like to ask a question, might I ask you please to raise your hand and wait for one of our attendants to bring you a microphone. For those investors that have joined us virtually, please click on the Q&A speech bubble icon and type your questions into the text box. Alex Denny on my right will then pose your questions to us. Are there any questions?
We have a few online if we'd like to start there. Kate?
Yes, absolutely.
Nitin, last year you mentioned that you might want to concentrate the portfolio into fewer positions. Is there a reason why this hasn't happened? Could you run, say, a 50-stock portfolio and reduce the turnover a bit?
My turnover is actually quite low. Actually, can we turn off the echo? Yeah, okay. So the turnover is not high, but the number of positions has continued to be high, but I cannot run a 50-stock portfolio in a small cap world. I think that will become a liquidity trap. You know someone in UK who tried to run a small cap concentrated portfolio with illiquid positions, and you know what happened to that person. I think that's very risky. Liquidity is a luxury in good times, but when you need it, there is no way out. So no, I'm not ready to take that risk of a 50-stock portfolio. Can I concentrate it a bit more? Yes, I can, but we'll have to wait for COVID to end for that, because what's happening with COVID is I'm unable to travel and meet companies. And when you can't visit the factories, when I cannot visit the shop floors, meet the managements in their offices, cannot visit their shops or their place of doing business, it becomes slightly harder to build conviction. And so it becomes harder to concentrate the portfolio. So we'll have to wait for travel to open for that.
Just quickly on Granules, when it expanded from 10 times to 20 times, did you top slice it at all?
Yes, I did. So I sold part of my position at 350. I should have sold more. But I still think, look, it's when you own a fantastic business, don't try to stand in the way of compounding unnecessarily. Yes, Granule looks like bad performance, but the stock is down only 15% after having gone up 3 times. So it's not a lot. It just looks bad because it was a big position and the market went up 35% in that time when the stock was down 15. So I don't want to interfere with the power of compounding unnecessarily.
I'm still looking at it. We've got plenty of questions on here. So,
if anybody do interject, anyone that's sitting here, if you like.
Just in terms of investments in China, looking at forward Ps, how reliable are earnings estimates in China, given that the government or government diktats, such as recent regulatory intervention, can dramatically change those estimates overnight?
Look, I think that's where our judgment comes in, that I try and buy businesses which do something positive for the society. So if you are part of businesses who are abusing either the customer or their market position or their employees or the environment, I think that risk is real, because Chinese government, I mean, I know people like to criticize the Chinese government, but actually I like them. They're doing what every government in the world should be doing. They're going after monopolies. They're going after bad corporate behavior. I would hope that other countries would follow their lead and rein in some of the bad corporate behavior of some of the large companies in the world. But I think it's important to own businesses which are doing the right thing by the society, which are doing the right thing by their employees, which are doing the right thing by the environment. And I think then you don't have that much to worry about.
Thanks, Nitin. There's a question here on carbon emissions. Obviously, there was bound to be. You've got investments in some oil and gas, energy, aviation stocks, for example. How does that sit with net zero targets? So I think kind of more near term. How do you think these businesses will perform in the next 3 to 5 years? And where do they sit with a global carbon price of $100?
Look, first of all, I do not have. I have one position in oil and gas, which is Senex Energy, which is a gas company in Australia. And gas, as you know, is a cleaner fuel versus other hydrocarbons. But also that's on the way out because it's been acquired. So I will be selling that in the tender process. I own a couple of thermal power businesses in CESC in India and Cikarang Listrindo in Indonesia. They both have historic assets which are thermal power, but incrementally it's all renewables. And I think it is wrong to say there should be zero thermal power. You know, you have to understand that emerging markets like India, China, Indonesia are in a different part of the cycle. That they are poor. They cannot afford to be fully renewable. Actually, even UK or Germany or Denmark can't afford to be fully renewable. And so there is need for certain of these legacy assets to continue. So I think they're okay till the time they're moving in the right direction. I own an airline, Cebu Air, and I own BOC Aviation, which is the largest aircraft lessor in the world. I really don't think if these companies have to start paying for hydrocarbon costs, which they may have to actually, by buying carbon credits, I think it just gets passed on to the consumer and travel becomes more expensive for us. Because Cebu Air doesn't emit carbon dioxide because it wants to emit carbon dioxide. It emits carbon dioxide because you and me decide to fly. But again, within airlines, what you want to do is you want to be with guys who have the best planes in the industry. So the newest planes, which have the least carbon emission per passenger kilometer. And that is an advantage if we start pricing hydrocarbons, because legacy planes who have higher emissions will become higher cost producers versus these guys. So if you look at Cebu, most of their fleet is going to be A321neo, which is probably the most efficient narrow body plane in the world. And BOC Aviation's average age of the fleet is 3 years. So they own very new planes, which by definition means they're more energy efficient.
Got time for 2 more?
I think so, yes, and then probably call it.
Great, yeah.
I'd like to ask one, but it's a bit personal, so I'll wait till the end.
Okay, no, fine.
So yeah, thanks, Nitin. Just a quick one on China Yongda, and there's a sort of an indication that the person who asked the question doesn't think it's very likely. But what would happen if the Chinese government were to put huge tariffs on imports of German cars?
Wouldn't be good. They would. I mean, BMW manufactures cars in China, so part of the demand would move there, which also are sold by Yongda. But for Porsche, that would be a problem. Obviously, it will get passed on, but there would be price elasticity, so the volume would go down. But that's the beauty of Yongda now, that a vast majority of the profit comes from after sales, right? So the business mix has changed dramatically over the last 5 years because the car park has become bigger and bigger. And as a result, a lot of your profit is now done in after-sales services, which you do for cars you already sold. But having said that, no, it wouldn't be good. But I think at 6-7 times earnings, we have enough margin of safety.
Thanks. Are we?
Would you like? Was that your last question?
I've got a few more that we could do. But
I think we'll do one more from you, and then maybe.
Yeah. Okay. Lovely. Another ESG question then, Nitin, which is on biodiversity, and I've got to try and work out the best way to ask this question. Do you think about the biodiversity risks inherent within food systems, and how do you kind of price in that risk?
I'm not sure I even understood the question.
It's some questions here around, for example, the palm oil industry. That is there a risk of effectively biodiversity actual collapse within the system? That the entire palm oil world goes because it's a single crop.
Oh, you mean that the weather patterns change enough that the palm trees are not, or where palm is grown is not fertile anymore? Is that the question? I'm not sure I fully understand.
I think the question is along the lines of, because it's a monoculture crop, is there a risk that effectively the whole palm oil thing blows up completely? Which would be fairly major, I guess, for a fairly stable food source.
Look at, how can we turn the echo off? I think it is a risk, but I've never seen any scientists or academicians that we talk to talk about it. There are no indications that something like that is happening, but could it happen 10, 15, 20 years from now? Maybe, who knows?
Thanks. It's actually a question about the Asian banking system. You hold a couple of large caps. You hold Taiwan Semiconductors, and Sinotrans is pretty big. Do you hold any of the larger banks, like Development Bank of Singapore or ICICI, which I know isn't the biggest bank in India? And if not, why not?
I do own some of the large banks. So I own 3 large banks. I own HDFC Bank in India, which is the second largest private sector bank by assets and the largest private sector bank by market cap in India. I own Axis Bank, which is the third largest private sector bank in India. And I own Shinhan Financial, which is the second largest bank in Korea. So I do own three large banks.
I think banks have a fairly bad rep, and they're also very much politically controlled. I don't know about the situation in India, is sort of what I'm asking. I guess it might be the same, but I don't know.
Alex, can you say that question again?
Yeah, so the question was, is there a reputational risk associated with that, and particularly with government interference in the banking system? And is that the case in India?
No, none of the banks I own are government-owned. The government-owned banks are the guys like State Bank of India, BOB, PNB. I do not own the government-owned banks. I own the privately owned banks. These are board-managed companies. But having said that, look, financial system everywhere in the world is, in the end, very, very steeply regulated. You go to the US, you go to UK, France, India, Korea. Doesn't matter which country you go to, the banking system is very highly regulated, and rightly so, because in the end, we as depositors give money to these bankers, and if they're not regulated, they will do funky stuff. Yes, there is regulatory risk always with a bank because they are deeply regulated, but they are not government controlled, the ones I own. And I have fairly high confidence in the management quality of the banks that we own. As I said in the beginning, that for me, honesty and competency of management are key inputs when I'm making a decision on any investment. And HDFC Bank obviously has the best management in India, and Axis Bank, since Amitabh's come in, who's ex-HDFC Bank as well, he's turned around the management culture of the bank. And Shinhan is obviously reputed to be the best managed bank in Korea.
I think there's still a few questions, but in the interest of time, given we've only got a few minutes left, if there's any we haven't got to, if anyone wants to email them through to us, we'll make sure that we get formal answers as well.
Perfect. And has everybody got your email address, Alex?
Yes, but I think if you were to email it to it's Fidelity Investment Trust @phil.com, that will come through to us.
Okay, lovely. Thank you very much, Nitin. And now, if I may now, to the formalities of the meeting. In accordance with the strict